Preparing for an accounting at Kellogg's interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does accounting mean in a consumer products company like Kellogg's? At Kellogg's, accounting means translating commercial activity into reliable financial information. In an interview, I would connect the three statements, explain period-end judgments, and emphasize controls over sales, inventory, and cash. I would also show business awareness. Cereal, snacks, and frozen foods involve promotions, retailer deductions, commodity costs, and manufacturing complexity. Accurate accounting helps management price, forecast, invest, and communicate performance consistently across reporting periods and operating units. While answering, focus on translating commercial activity into reliable financial information, connecting the three statements, and recognizing the importance of inventory, promotions, manufacturing costs, controls, and consistent reporting. Question 2. Can you explain the accounting equation and give a practical example? The accounting equation is assets equals liabilities plus equity. I use it as a diagnostic framework rather than memorizing it. A cash purchase of inventory increases inventory and decreases cash, leaving total assets unchanged. A supplier purchase increases inventory and payables, increasing both sides. If an entry does not preserve the equation, I investigate account mapping, timing, or a missing debit or credit. That discipline supports clean trial balances and dependable statements. Make sure to cover assets, liabilities, and equity, explain how debits and credits affect the equation, and use an inventory or supplier transaction to demonstrate the relationship practically. Question 3. Why does Kellogg's use accrual accounting instead of cash accounting? Accrual accounting gives a more accurate picture of performance because it records economic activity when earned or incurred, not when cash moves. If Kellogg's receives manufacturing services in December but pays in January, December should include the expense and accrued liability. Similarly, customer promotions may require a sales deduction before cash settlement. This approach matches revenue with related costs, improves comparability between periods, and prevents payment timing from distorting operating results. In your answer, talk about matching revenue with related costs, recording obligations when incurred, distinguishing cash timing from economic performance, and using accruals for expenses, rebates, bonuses, and utilities. Question 4. How would you account for customer promotions, rebates, and trade allowances? I would treat customer promotions and rebates as variable consideration that generally reduces reported revenue when the related sale occurs. I would review contractual terms, historical redemption patterns, retailer data, and current promotional activity to estimate the obligation. The entry typically records a reduction of revenue and a refund liability or receivable adjustment. I would true up the estimate as claims arrive, investigate unusual variances, and document assumptions for review and audit support. Be sure to mention variable consideration, estimating expected deductions, reducing revenue when appropriate, using historical data and current contracts, and updating estimates as sales or settlement information changes. Question 5. How should inventory be valued and what risks are especially relevant to Kellogg's? Inventory is initially recorded at cost, including appropriate direct production costs and allocated manufacturing overhead, then assessed for recoverability. I would test whether carrying value exceeds net realizable value and consider obsolete, damaged, slow-moving, or discontinued products. At Kellogg's, demand changes, retailer promotions, commodity prices, and production variances could materially affect the estimate. I would reconcile physical counts, investigate differences, and record reserves supported by aging and forecast data. While answering, focus on cost accumulation, lower of cost or net realizable value testing, obsolescence, damaged goods, demand forecasts, commodity prices, production variances, and physical inventory controls. Question 6. What happens to the financial statements if ending inventory is overstated? If ending inventory is overstated, cost of goods sold is understated because COGS equals beginning inventory plus purchases minus ending inventory. That overstates gross profit, operating income, pre-tax income, inventory, and equity in the current period. In the following period, the error reverses through beginning inventory, depressing reported profit if uncorrected. I would trace the issue to count sheets, receiving and shipping cutoff, standard costs, or obsolete inventory reserves, then quantify and correct it. In your answer, explain the immediate income statement effect, the balance sheet effect, the subsequent period reversal, and how cutoff errors or count inaccuracies can create the overstatement. Question 7. How would you distinguish capital expenditures from operating expenses? I capitalize a cost when it creates or improves an asset that provides probable future economic benefits over more than one reporting period. Routine repairs, maintenance, and ordinary production expenses are generally expensed as incurred. For a new manufacturing line, I would capitalize qualifying equipment and installation costs, then depreciate them over the useful life. The cash flow may occur immediately, but capitalization changes the timing of expense recognition and increases fixed assets initially. Make sure to cover future economic benefits, useful life, capitalization thresholds, repairs versus improvements, depreciation, and the effect on earnings, cash flow, and the balance sheet. Question 8. Walk me through your month-end close process. I would begin with a close checklist, deadlines, and clearly assigned ownership. I would reconcile cash, accounts receivable, inventory, fixed assets, payables, payroll, and intercompany balances, record-supported accruals, and verify revenue and shipment cutoff. Next, I would review account fluctuations against budget and prior periods, investigate unusual movements, obtain journal approvals, and confirm the trial balance ties to reporting systems. Finally, I would document open items and communicate material issues promptly. In your answer, talk about the close calendar, subledger reconciliations, accruals, intercompany balances, inventory and revenue cutoff, variance review, journal approvals, and post-close adjustments. Question 9. How does a bank reconciliation work, and what would you investigate? I compare the bank statement balance with the cash ledger, identify timing differences such as outstanding checks and deposits in transit, and record items the bank processed but the company has not yet booked. These can include fees, interest, return payments, or electronic transfers. I would investigate old or unusual reconciling items, verify supporting documentation, and ensure the adjusted book balance agrees with the bank balance. Reconciliations provide both accuracy and fraud detection benefits. Be sure to mention comparing the bank statement with the ledger, identifying outstanding checks and deposits, recording bank-originated items, investigating unusual reconciling items, and confirming timely resolution. Question 10. What internal controls are important over revenue and cash collections? Key controls should separate order entry, credit approval, shipment, invoicing, cash application, and refund authorization. I would require approved pricing and promotional terms, evidence that goods were shipped, controlled customer master changes, and review of credit memos and unusual discounts. Cash receipts should be reconciled to bank deposits and accounts receivable regularly. Access should follow role-based principles, with exception reporting and independent review designed to catch errors or inappropriate transactions. While answering, focus on segregation of duties, customer master controls, approval of pricing and credits, shipment evidence, cash application, reconciliations, access restrictions, and monitoring of exceptions. Question 11. How would you analyze an unfavorable gross margin variance? I would decompose the variance rather than assume it reflects poor performance. I would compare actual price, volume, product mix, promotional deductions, commodity inputs, freight, labor efficiency, manufacturing overhead, and foreign exchange with budget and prior year. For example, lower margin might reflect a higher share of discounted products rather than weaker pricing overall. I would validate the analysis with operational data, identify controllable drivers, and recommend actions such as repricing or sourcing changes. Make sure to cover price, volume, mix, promotional deductions, commodity and freight costs, labor efficiency, inventory adjustments, foreign exchange, and separating controllable from non-controllable drivers. Question 12. When might goodwill or an intangible asset require an impairment charge? An impairment review is needed when triggering events or annual testing indicate that goodwill or an intangible asset may not be recoverable. I would examine declining sales, lost customers, margin pressure, restructuring, adverse market conditions, or a sustained fall in valuation. The analysis compares carrying value with estimated fair value, often using discounted cash flows and market multiples. I would challenge revenue growth, margins, discount rates, and terminal assumptions because small changes can materially affect the conclusion. In your answer, discuss triggering events, reporting unit performance, forecast deterioration, market capitalization, discounted cash flows, fair value comparisons, and the judgment involved in assumptions. Question 13. How would you account for a lease of a manufacturing or office facility? I would first determine whether the contract conveys the right to control use of an identified asset, then identify lease payments, term, options, and any non-lease components. At commencement, the company generally records a right-of-use asset and lease liability based on the present value of payments using an appropriate discount rate. I would subsequently record interest, liability reductions, and amortization or operating lease expense, while reassessing modifications and renewal assumptions when facts change. Be sure to mention identifying the lease, separating lease and non-lease components, recognizing right-of-use assets and lease liabilities, discounting payments, and reassessing modifications or renewal assumptions. Question 14. Suppose sales fall sharply while inventory rises. How would you investigate the accounting and business implications? I would first confirm the data and investigate whether the increase reflects production timing, retailer destocking, forecast error, acquisition activity, or a cutoff problem. I would compare shipments, sell-through, purchase orders, production volumes, inventory aging, and subsequent sales. Rising inventory with falling demand can increase obsolescence reserves, consume cash, and signal weaker future margins. I would also test revenue recognition and channel incentives to ensure shipments were not accelerated simply to meet targets. In your answer, connect demand, production planning, channel inventory, cutoff, obsolescence, reserves, working capital, cash flow, and potential pressure to recognize revenue prematurely. Question 15. Tell me about a time you found an accounting error. What did you do? In one close, I noticed an expense account was unusually low compared with both budget and the prior month. I traced the variance to an invoice batch posted to the wrong period, quantified the impact, and discussed it with the preparer and reviewer before proposing an adjusting entry. I documented the evidence, corrected the account, and added a checklist step for invoice cutoff. The experience taught me to combine analytical review with respectful, fact-based communication. Make sure to present a concise situation, explain how you identified and quantified the error, describe communication and correction, and finish with the control or process improvement that prevented recurrence. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.